Hello and welcome to Crypto Jargon, the series where I'm breaking down the complex crypto-related terminology. In this episode, I'll explain what is a candlestick chart, depth chart and trading walls, and I will also talk about the types of trading such as day trading, swing trading, and position trading. Okay, so let's get started with candlestick charts. These originated in Japan in the 18th century when the Japanese rice trader Monehisa Homa discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. He invented the candlestick chart, where there is a multitude of candlesticks showing that emotion by visually representing the size of price moves with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of the price. A candlestick shows the market's open and close price as well as the high and low price for a fixed time period. If that period is a day, we call it a day candle, or if the parameters are set to 1 hour, it's an hourly candle. It can also be a weekly or even monthly period, or as little as 1 minute or 5 minutes or 15 minutes, and so on. If you are a position trader, for instance, you wouldn't care much about these smaller time frames. You would rather analyze the daily, weekly, or even monthly candlesticks. But if you are a day trader, you would care about the smaller time frames, as you would be working within a very short time limit. I'll get to the types of traders in a moment, but first, let's use the daily candlestick and give an example of what it looks like and how to read it. The candlestick has a white part, which is called the real body. The real body represents the price range between the opening and the closing prices of that day. When the real body is filled in green or black, it's a bullish candle, meaning the close was higher than the open, so the prices went up that day. If the real body is red or white, the close was lower than the open, in other words, the prices went down that day. They were higher when the trading day started than when it ended. Just above and below the real body are the shadows or wicks. The wicks show the highest and lowest price points of that day's trading. If the upper shadow on a down candle is short, it indicates that the open of that day was near the high of the day, or when it's much longer, it shows us that the prices went up much more during the day, but the day started at the price that was far below the high. In short, the wick of the candle extends to the highest and lowest price of that day, while the full body indicates the price range between the open and close for that day. There is a lot of activity during a day, and all that activity is represented by that one candle. If we look at this smaller time frame, these are all 15-minute candles over a period of 1 day, we see a much more detailed picture on what is going on throughout that day. The price is going down and down again multiple times during the day. So all of this information is squeezed here in this 1 day candle. The main body shows us the opening and the closing price, and the wick tells us where the highest and lowest prices were, and the length of that wick compared to the length of the body is also indicative, which is why we have some really short candles indicating that there wasn't much volatility in the price range for that day, or it can be a very long candle when the prices were moving quite a lot with a larger margin. This is why there are many types of candlesticks, such as the doji, the evening star or the morning star, a hammer, a hanging man, and many others. Candlesticks are really containing a lot of information about the trading activity of their time frame, and this is why they are the most widely used method of technical analysis. There are other charts that traders use besides candlestick charts, and one of these is called a depth chart. A depth chart is a graph showing how many limit sell orders and limit buy orders are currently open on a certain exchange. Limit order, by the way, is explained in another episode of Crypto Jargon, so make sure you watch that one too. See the description box for more details. The depth chart shows the cryptocurrency's liquidity at that exchange. Buy orders are displayed in green and the sell orders in red. By reviewing the depth chart, you will find the likely market appetite for a certain buy or sell price. The higher the volume of orders at any given price, the higher the amount of green or red field will be. When there is an extremely high volume of orders at a certain price level, the graph can resemble a wall, which is referred to as a trading wall. If a wall is created by a large buy order, it's called a buy wall, and if it represents a sizable sell order, it's called a sell wall. This can also be called bid walls, and in many occasions they can even be fake walls, meaning that whales or other market manipulators are placing these orders temporarily only to sway other traders into a certain direction and move the market. Fake trading walls often disappear shortly after the targeted price movement happens and before they get executed. And they are only relevant to day traders since they are the ones who trade within really short time frames. So let's explain day trading. This is the practice of buying or selling an asset with the beginning to end process of it taking place within 24 hours. Day traders look for small price shifts minute to minute and do their best to maximize their profits or minimize their losses by making several transactions a day, but without leaving any open orders overnight. Day traders depend on micro trends, which are minuscule shifts in the market value, as compared to position traders who may observe the trends of an asset over several days, weeks, or even months before taking an action. Next, I want to mention swing trading, which is a style of trading that attempts to capture gains in an asset over a period of a few days to several weeks. Swing traders primarily use technical analysis, but they may also utilize fundamental analysis to look for trading opportunities, and they are not concerned with the long-term value of an asset. Swing trading is mainly used by at-home traders and some day traders as well. Large institutions trade in sizes that are too big to move in and out quickly, while the individual trader is able to exploit such short-term price movements without having to compete with the major traders. And moving on to position trading, which I mentioned already in contrast to day trading. This is an investing strategy in which open positions are held for an extended period, and by extended, I mean weeks or months and even longer. Position traders will hold their asset for a while with the expectation that it will appreciate in value. They are less concerned with short-term fluctuations and the news of the day unless it impacts the long-term view of their position. In this regard, they do not trade actively. Many of them place less than 10 trades a year. Position traders are by definition trend followers. Their core belief is that once a trend starts, it is likely to continue. Only the buy and hold long-term investors, who are classified as passive investors, hold their positions for longer periods than the position traders. Enjoying this content? Go check out Crypto Jargon, the ebook, out now on Kindle. It's an Amazon bestseller and it's the most up-to-date crypto dictionary with more than 700 terms, acronyms and trading slang related to cryptocurrencies and blockchain tech. Just go to ojjordan.com/cryptojargon and grab your digital copy today.